In terms of history, let's start at the beginning. In what year did you start selling?
Born at a very early age, started life as a child.
Tell us about your start in Toronto's condo market.
Well, it's funny because when I chat with people, there's a few gray hairs in the audience, but, we opened our business in 1976, and people often forget that it was only 1967 that condominium legislation was enacted in Ontario. So prior to that, there weren't any. The first 10 years, the industry was kind of bumpy because nobody had any real experience, but 1976 was kind of the year that there were 3 or 4 fairly, what was considered at the time, high-end luxury projects in the city of Toronto. One called Harbor Square, which was about $60 a square foot. One Hazelton Lanes, which was a high-end one, $100 a square foot. And 2 other ones, 150 Heath and Hazelton, and Palace Pier. So as silly as that sounds, I mean, it's 35 years ago. It's not a century ago. So, because often people say, well, your clients may say, how do you make money in real estate? And we often joke that, Warren Buffett, who's the world's best investor, has 2 rules for investing. Anybody know what they are? So rule number 1, don't lose your money. But it's interesting, here's a guy that's the best investor purportedly in the world, and that's a pretty defensive strategy, wouldn't you say? So what's rule number 2? See rule number 1. So here's a totally defensive strategy. So if you kind of make a corollary of that, I mean, what I advise people in real estate is that the way to make money is not to lose money. So if you do 2 things, and only 2 things, you won't lose, and if you're not losing, then you're going to make. So it's don't buy more than you can afford, and don't sell it at the wrong time. Because there's no other investment. You can't say that in the stock market. It's a perfect market. Everybody knows the price, but nobody knows what anything's worth, right? In the real estate market, if you purchase something, it's the get rich slow plan. So you're basically owning something, and you're paying off a mortgage, so you've got a little bit of appreciation, a little bit of principal repayment. And if you're living in it, that's great. If a tenant's paying off your mortgage, even better.
Now, back in the 70s, what was a typical suite like?
Well, again, the sizes were different. A studio was 600 square feet. A 1-bedroom was 1,000. There was a 1-bedroom and a junior 1-bedroom product that was about 750. Two bedrooms were 1,400 to 1,600 square feet. I mean, if you go to buildings like 33 Harbor Square or 109 Front, 110 Bloor, there's buildings that were built between, let's say, 1976 and 1984. That those suites were very large. So as the world progressed time-wise, suites got more efficient size-wise because as the costs went up, as land costs went up, and hard costs and soft costs, as prices went up, sizes went down to keep affordability.
Out of curiosity, was $60 a square foot considered expensive?
Well, it was not only considered expensive, it was like people would come in and they'd say, well, now how's this going to work? Like you're telling me that I can buy this little piece of the sky, there's no land, who's ever going to buy it from me again? So it was really much more of a generic sale. I mean, it's interesting today that it's very much mainstream. But it was really a very, very difficult sale in the beginning because it was new.
Now, I'm assuming back then there were a lot more apartment buildings. What caused the shift from apartments to condos?
Well, they often, Frank Clayton, who's a research analyst, wrote a, kind of an article recently. It was in one of the builder magazines how there was kind of a perfect storm lined up for the condo market. The Green Belt was enacted. It restricted the low-rise supply. I think George was here this morning, so he probably told you in the year 2000, 2/3 of the sales were low-rise, and last year it was the other way around. About 1/3 of the sales were low-rise and 2/3 were high-rise. So you had low interest rates, and you had rent controls that came in the 70s that basically made it uneconomic for developers to build rental buildings. So what it did was it enabled an investor who was maybe disillusioned with the stock market or just wanted to have something real to be able to know that they were going to rent those units. One of the things often too in addressing a group of agents, like if you think of your practice and the way it's probably been, you're responding to people's needs. Someone calls you up, I need to buy something, you show them something, you sell it to them. I mean, when are they going to call you again? You know, maybe they're going to live in that home 5 years, 10 years, 15 years. So you're listing, you're selling, it's pretty much needs driven. But if you think of it a different way and you say, okay, well here I've got this database of clients, maybe there's 50, maybe there's 300, whatever there is in that group of people that you've listed or sold, you know, what do they do with their investment dollars? You know, are they, you know, probably talking to someone who could be 2 paychecks away from being homeless, who's their investment advisor, who's telling them to buy mutual funds because they make a commission and they don't really know anything else. So, you know, I think it's entirely productive and very responsible for you to talk to those people and say, don't buy more than you can afford, don't sell at the wrong time, but, you know, consider some of your investment dollars in the real estate market.
Now, when David Wex was here, we asked him the difference between Toronto versus Montreal and Ottawa because he sells in those cities. How does Toronto compare from the condo market to other major metropolitan cities around the world?
Well, if you look at cities like Beijing and Shanghai and Delhi, you know, you've got 50, 60,000 units a year being sold. You know, they're huge markets because they've come from a very, very low base. But I believe Toronto, if you took the top 5 or 8 cities in North America, including New York, Chicago, San Francisco, all the bigger cities, you know, those top 7 or 8 or 9 cities combined don't have the same volume of condominium sales as Toronto does on a new basis. So in one sense, it's at the leader of the pack in North America, you know, with, let's say in the last 5 or 6 years, an average of around 15 to 20,000 new sales per year, but much, much less some developing countries.
And what is it that's creating this demand? Why is there such a demand for condos in Toronto?
Well, I think one is an affordability. I mean, you know, the holy grail is the single-family house. Everybody would really prefer probably to live in a single-family house. I mean, most people, if they could, probably wouldn't choose a condo first pick. But if you think of the average price of a single-family house in the core, it's in excess of $1 million. I mean, the average price of a new single-family home in 905 is about $570,000. Average price of a condo is about $430,000. So, you know, if you're purchasing a single-family house, I mean, if you need it and you can afford it, that's great. But people buy what they can afford. So I think that there's just a significantly larger group of people that can afford condominiums than can afford a single-family house.
Now, a lot of the people in the audience probably have clients who may want to invest, and they're saying, you know, I should probably get into a resale condo. How would you compare as an investment pre-construction to resale?
Well, you know, there's some advantages and disadvantages. I mean, there's always a gap between the resale price and the new sale price, but typically, if you think of a life cycle of a community, of a project, like some of the ones that were mentioned here, you know, River City or Bond or Victory, I mean, there's typically, you know, about a 3 to 4 year time period from when you actually begin to purchase and when you get delivery. So, you know, so the 2 best times to purchase for you or your clients, I think, would be really either right at the launch or right at the moment that the developer needs 5 or 10 or 15 or 20 more sales to get to that construction financing target. I mean, those are usually the 2 best times. One is you get first pick, and the other is you might get the best incentives.
And you mentioned Warren Buffett's rules, but what are you, I'm assuming you've invested in condos here and there. What are your own personal rules when it comes to condo investment?
Well, I don't know whether I followed my own risk because I bought maybe a little bit more than I could afford. No, I didn't really. But I own quite a few condos. I mean, you know, I like the condo business. It's been good to me. So I have a fairly large number of units. And I've always found that if you purchase a pre-sale as opposed to a new sale, a pre-sale as opposed to a resale, that you've typically got some appreciation before you ever need to close on it. I mean, if you do, I mean, historically you've got a market that's going up at 7% a year, but even if you do the math at, let's say, 3% a year, you know, if something compounds in value at 3% a year for 4 years, it's not 12%, it's 16 or 17 or 18%. So if you're putting a 15 to 20% deposit down, on a very simple basis, you've really almost doubled your equity before you've even closed, and you don't have any management headaches yet. That's the other reason why people prefer to invest in condominiums as opposed to a single-family home, because you've got a property management. You know, you rent it out, you get 12 post-dated checks for rental, or get an automatic withdrawal, and you pay your common expenses and taxes, and mortgage, so it's really not a big management headache.
Now, in terms of the city or maybe downtown, what would you consider a safe bet in terms of location?
Well, I think the best locations are really related to transit. It's subway stops, streetcar tracks. I mean, the entertainment district has been very popular. New neighborhoods like West Donlands, you got Pan Am games coming. The other thing that not everyone is aware of, especially if your practice has been largely resale, when you purchase today, when a purchaser purchases today, at most sites, they can get a capped rate mortgage. So they can get a mortgage approval for today for 80% of that purchase price at a fixed rate that usually is held for up to 36 months. And when you get to within 24 months, they'll drop it. Within 18 months, they'll drop it. Within 12 months, they'll drop it. So if you assist your client in managing that mortgage approval process, that's very good too, because it's obviously a large cost of carrying a unit.
Now, you've been in the industry for 30 plus years. Let's pretend you had a crystal ball 30 years from now. How do you see, if history tends to repeat itself, what do you see happening over the next 30 years?
Well, what's the average price per square foot of downtown Toronto today? $600. So the average price of Harbor Square and Palace Pier 35 years ago was $60. So that's 10 times. So I would say that I don't think it'll take that long, and I don't think for that market to increase by 10 times again. I mean, there's more evidence today, I believe, that would suggest that. And it's not that the condominiums or the real estate is really worth that much more. It's just that the money's worth less, right? I mean, there's a creeping inflation built into all Western economies. So if you've got, again, if you've got 2, 3, 4% a year inflation, if you start to compound that. You need a 6 or 7% increase in market to get ahead, and it's 3, 4% is just going to keep you even. So I believe that the next 3 decades will be very much like the last few decades. There's going to be some cycles, there'll be some ups, there'll be some downs, there'll be the real estate market is always cyclical. But again, if you go back to your 2 rules, if you don't sell at the wrong time, and presumably the corollary of that is you don't have more than you can afford, then you can basically not be squeezed and forced into selling at the wrong time.
Now, I'll ask you the same question I asked the developers. What do you see as upcoming trends to watch in the industry, whether it's design trends or different amenities, materials used, architecture?
Well, it's interesting. I was at a meeting this morning with one of the provincial ministers, and they said, why doesn't someone come out and design an innovative community? Where is a community where it's the easiest for someone in their 20s to start a business and buy a house or buy a property? So, I think that, we've had a lot of, call it branded type projects. The hotel brands like the Four Seasons. When people purchase condominiums, in our research, they really do it for 3 main reasons. They do it for brand, location, and view, and not necessarily all in those orders. There's other issues, ceiling heights, amenities, but those are typically the biggest drivers. So I think that in the future, we've got a great industry here of developers, and everybody's very creative. But so I think that you'll see, definitely more creative amenities and more themed type projects. On the drawing boards, as markets segment, you might see a condominium that would be typically totally designed for pet owners.
Interesting.
So,
now you've had the luxury of your experience. Is there a way to dive deep and figure out what types of projects have seen the best appreciation, or types of suites, or suite styles, number of bedrooms, views? If
well,
you had to pick.
I was just chatting with someone else earlier today. If one of the things that we get to determine, my job is the developer will come to say, look, we just bought this site, we can build 400,000 square feet. What should we build? The mix. How many studios? So it's really like kind of where you get to draw a puzzle, make the sizes and cut the pieces. So how many studios, how many ones, how many 1+ dens, how many 2s, how many 2+ dens, do you want 3s or not, and how big should they be? Keeping in mind that, you have a given that, in order for it to be economic, it may have to sell for X number of dollars a square foot. So, you know, the way we do it and the way everyone else is doing it, I mean, there's a big risk mitigation exercise out there because, you know, you heard David Wex from Urban Capital mention risk mitigation. So you've got approval risk, so once that's over with, you really have market risk. So the fastest that you get to that 65, 70, 75% pre-sale target, the safer it is. And, you know, other things being equal, the more affordable those homes are, the quicker they're going to sell. So the majority of units today are being created as one bedrooms and one bedroom and dens. Some studios, some twos. So as you get up the food chain in terms of size, those units are getting fewer and fewer. So I agree with Giovanni. I think that if you think of, let's say, an average 400 suite building, probably 65% of the suites are studios, ones, and one plus dens. And maybe even fewer, maybe 70%, 75%. So you've got a quarter to a third of the suites that are 2 bedrooms or 2 bedrooms and dens or larger. So, you know, where is the future demand? So I think that if you think of supply and demand, if there's less supply in those bigger suite areas, I mean, they could tend to appreciate faster. Because historically, the ones and the one plus dens always had a little bit better rent to price ratio. You could get a little bit higher per square foot rent on a one or one plus den. But that seems to be changing a little bit just because there's not as many 2 bedrooms.
Right. Now, in terms of future development, what do you see as sort of the hot zones in terms of new neighborhoods or upcoming areas in the city that could be a potential for great investment?
Well, you know, I think again, if you look at where all the activity is, if you look at an area like, you know, West Donlands, where you've got the Distillery District, you've got communities like River City, you've got the Pan Am Games that's coming. You know, in 2015, for 3 weeks, there's going to be 9,000 athletes that come for 3 weeks, and that's just the athletes, not to mention the press or families or whatever. You know, the entertainment district sort of between Queen and Spadina and Front and University, I mean, that's been a very, very popular area in the last few years. We did a number of buildings there that have been quite successful and still have great opportunities. There's Bond, there's Tableau, you know, in that neighborhood. There's a lot of great opportunities. But I think also if you look at Metrolinx, if you go to the Metrolinx website, you know, they have transportation nodes. So I think that you'll look at Don Mills Road in Eglinton, they've said that's going to be a hub. Bloor and Dundas is going to be a hub. You've got streetcar, you've got subway, you've got GO station. There'll be a rail link between Union and the airport. So I think if you look at those Metrolinx nodes, those are going to be good spots.
Yeah, I think that's a big deal because, as I mentioned before, in 10 years, 1 million new people coming to the city, no one's going to want to drive anywhere. And public transit is going to become more and more important, especially if you live near it. So if you figure out where the transit's going to be or where it is already, you can make a great prediction on what's going to happen in the future of the city. Now, now we talk about neighborhoods. What about, let's say, over the next 12 months, what would you consider to be the projects we should be looking out for?
Gee, that's like an opportunity for a commercial, isn't it? You know, I think again, the two best times to buy, in my opinion, are either at a launch, where you get first pick and opening day price, or where there's an opportunity to purchase something where that developer needs 10 or 15 or 20 sales prior to construction financing. So, you know, we've got one of the projects in the entertainment district that we mentioned was Bond. So it has, you know, they're doing a promotion there now where they're doing a furnished suite because they're in that kind of zone where they need those 10 or 20 sales for that construction financing. One of the great things for an investor is that what's called a vendor leaseback. So if you've got an investor purchaser and they're buying today for delivery 3 years from now, you know, they do have to rent it, right? So they've got a commission to pay, they've got some management, even if it's minimal. So often the vendor will say, okay, well, we'll take away those headaches. We know this is going to rent. If it's a, you know, 1 bedroom and a den, it's going to rent for $17.50 a month. So we'll lease it back for 2 years from the day of occupancy. So if you, then that investor client of yours has got sort of a 3-year trouble-free run before occupancy closing, and then another 2 years where they don't really have to think about it. So it's kind of like a 5-year bond. So I think that You know, if you look for special promotions and because often at opening it's good, but it doesn't always end up to be the best buys.
So, thank you, Mr.
Great.
Milborne.
Thank you.